Welcoming everyone to our third chapter discussion. So in the last two sessions, we spoke about some of the basic concepts related to strategic financial management. Today we are going to discuss about what we call treasury management. So treasury management, so when you talk about treasury management, you all can remember during your school days when you all were in clubs and societies, there was a person called treasurer who was entrusted with collecting money and managing the expenses. When you talk about treasury management in relation to the corporate world, the scope of treasury management is much more broader in terms of scope and in terms of relevance. So when we talk about treasury management, what you need to understand is every organization doesn't exist in isolation. Organizations does not exist in isolation. Organizations need to obtain cash. Organizations need to obtain cash and use those cash to manage operations. So cash is very important to organizations. So that is why many organizations have treasury management in order to, one of the fundamental duties of treasury management is to manage the cash flow. But the more broader picture that people need to understand is when you obtain cash and when you use cash, the organization doesn't exist in isolation. The organization is impacted by what we call financial markets. Where do you get money? Corporate organization needs to get money from financial markets. It can be equity market or it can be debt market. So equity market, you can raise money from IPO or a rights issue. You can raise money from debentures or you can get a bank loan. So what you need to understand is not like the clubs and societies that you dealt with during school days. When we talk about corporates, we talk about huge volumes of cash that you need as an organization and that you need to use when it comes to managing operations. So where we obtain cash and where we use our cash also will be impacted by financial markets. The problem with the financial markets are these financial markets are volatile. The volatility of the financial markets directly impact when you obtain money and directly impact the organization when you invest money. So this is where treasury management is important. When the financial markets are volatile, when you borrow huge sums of money like in millions and billions, even 1% change in your borrowing rate creates a huge impact to the bottom line of the organization. So when you are borrowing 1 billion rupees or 1,000 million, when the interest rate increase from 12 to 13%, that creates a huge impact to your bottom line. So you need to manage this market volatility in such a manner so that it doesn't disrupt your overall operations, and that is exactly the function of treasury management. Because the markets are volatile, you need to reduce the impact of market volatility impacting your organization. That is why treasury management is becoming very important. Because at the end of the day, when you obtain funds, even for the long term and the short term, you are impacted by market variables, you are impacted by economic variables such as the interest rates or the foreign exchange rates. So these variables change continuously. In the case of Sri Lanka, of course, interest rates are determined by more or less by the central bank, but nonetheless we tend to see in the last 2 to 3 months AWPLR rising. Even an increase by a small margin can impact the bottom line of the organization in a very big manner. So when these financial variables change, when these economic variables change, the impact to the organization is high. That is why we have treasury management as a function. So in simple terms, treasury management is all about managing the money, that is one, and managing the market risk. Market risk meaning when you obtain funding and when you invest money, you are impacted by economic variables. So these risks you need to mitigate. Mitigating that is very important in terms of treasury management. So I have given you some definitions of treasury management, but the fundamental rationale remains the same. So in terms of treasury management, the treasury department needs to work alongside with other departments, and treasury and the financial control departments need to work together in order to ensure that you are taking the right decisions, So what are the three main functions of a treasury department? The first one is managing the liquidity of the organization. Every organization receives cash, every organization uses cash. How do we manage our cash flow? So that is managing the liquidity. Liquidity management is all about managing the cash flow. Managing the capital structure. Capital structure is all about your funding side. How do we manage our funding? How do we manage our enterprise funding so that the organizational value will increase, so that the organizational value and the shareholder wealth increase? Managing your funding, managing the funding side or the funding area, that is what we call managing the capital structure. Do we rely more on equity or do we rely more on debt? Your capital mix, important considerations are your capital mix. If we are going to expand our operations, are we going to use a rights issue or are we going to use more debt capital? Rights issue gives you the flexibility, but you are obtaining the money from the owners. If the owners are unhappy, that can create huge problems. Whereas debt capital, you need to pay interest, a cost is incurred to you, but because the debt holders are not owners, there is less of a effect where owners becoming dissatisfied if something goes wrong. So managing your capital structure is all about funding, the capital mix, and your managing the weighted average cost of capital. We are going to discuss these concepts later. And managing the financial risk. Managing your financial risk. Here it says financial risk management integration. So you need to manage your financial risk, and also you need to connect your risk initiatives with the overall risk management framework of the company. So treasury management, the risk management done by the treasury department, that should be aligned to the overall risk management framework of the company. So an organization cannot have two risk management departments, but the treasury management should be aligned to the overall framework of risk management of the company. That is why we have mentioned financial risk management integration. So I hope I gave you all a good understanding of what treasury management is all about. So in simple terms, treasury management is all about managing the money, but it is not only about managing the money. managing your liquidity, managing your funding, and managing the risks during the whole process, and integrating the risk management efforts that you do with the overall risk management framework of the organization. These are the main functions of the treasury department. So the first function, liquidity management. So liquidity management, as the name itself, as implied by the name itself, it is about whether you have enough money to manage your operations. Do we have money to manage our operations? Do we have money to manage our business requirements? Do we have money in line with the business decisions that we are going to undertake in future? So it is not only, when we talk about managing money, there are two things. So you need to assess how much money you are going to receive, how much money is required in future. So if I am going on a vacation in the next month, right now I should have sufficient money to manage that. So in the same manner, from the organizational perspective also, if there are huge capital expenses in the upcoming months, you need to have cash reserves right now to manage that, or emergency credit lines being discussed so that when the requirement arises, you can use that. So liquidity management is all about optimizing your cash position. Optimizing your cash position to meet your obligations and to manage your operations. What is the best level of cash we should have as an organization? So you might think having more and more cash is good. So people who do not have knowledge about economics and finance, they think, okay sir, having more and more cash is good. Why do we worry about liquidity and treasury management? That is completely wrong. You need to optimize the cash balances in an organization. Having too much cash and also too little cash, that can be detrimental to your operation. Now I am going to explain why. So what do you think about the relationship between liquidity and profitability? Liquidity and profitability has an inverse relationship. The problem with holding on to too much money, the problem of holding on to too much money is, so let's say we are holding on to 300 million as cash balances, but the profitability we generate out of that is very much low, because when we have cash as balance, we are not investing that cash. So when you have cash in your account, that means you are not investing that cash at the moment. So you are losing on profitable opportunities in terms of investing that cash. So always remember, you need to optimize your cash. Having too much of cash is also a bad thing, because when that happens, you are not investing your cash in profitable ventures. So when your liquidity increases, ultimately what happens is your profitability declines, and that is bad for the organization. On the other angle, when your liquidity is low, let's say 50 million, but your profitability is very high, let's say 80 million. What is the problem there? In case you require sudden money, you do not have money. In case if there is a sudden requirement, or if there is a sudden business requirement, or if there is a sudden business emergency, you do not have money to use. So that will create a liquidity crisis. So liquidity management is all about balancing both. What is the optimum cash balance that you should have as an organization? First thing that you need to do under liquidity management is you need to forecast your cash flow. What are our future business requirements? And how we are going to finance those? that is validating cash flow forecasting. And you need to double check also. So forecasting is one, and you need to cross check whether your forecasts are correct also. If your forecasts are wrong, then you are in great danger. So you need to do two things. You need to get your forecast, you need to prepare forecast, you need to prepare the forecast, and also you need to check the forecast also to see whether it is correct. You should see, looking at your historical performance, whether the forecast shows the correct numbers, whether the forecast shows the reality for your business segments, and whether it is in line with your past performance. The next thing that you need to do is you need to optimize the liquidity buffer. So as I told earlier, there is an inverse relationship between liquidity and profitability. When you hold on to cash, what happens is you are losing on profitable ventures. You are losing out on profitable ventures, the return that you could have generated. This is what we call opportunity cost when we talk about economics. Also, when we invest all of our money, if there is a sudden business emergency, we do not have any cash. So that creates a liquidity crisis. So you need to create a balance between liquidity and profitability. So if your buffer is too much, then you are losing out on profitability. But if your buffer is too low, there could be a liquidity crisis. So what you need to understand is, having a proper liquidity buffer is a very critical thing when we talk about liquidity management. You need to optimize the liquidity buffer. So if you invest too much in financial markets, increasing profitability, you should be aware of the fact that there can be financial shocks. You should be very concerned about that. So you can use techniques such as cash flow at risk in order to evaluate so there are financial models. And one of the models is cash flow at risk. So you can use these models to evaluate how much of cash you need to have within your business. You need to optimize your cash buffer by balancing the opportunity cost of holding on to money. So when we hold money, there is opportunity cost against the quantifiable risk of operational and market disruption. When you invest money, you are exposed to market disruptions. So if I invest the surplus cash in the share market, if the market drops, then I am losing out. So you need to look at the opportunity cost of holding on to excess money and market risks and the market risks that you are exposed to if you invest that money. So there is a trade-off between those two. You need to evaluate the trade-off very precisely. So the next part of treasury management, managing the capital structure. So as I told earlier, capital structure is all about managing your funding sources. What is, whether we are funding our operations by using equity or we are going to fund our operations by using debt. So you need to manage funding in such a manner that the value to the organization increases. When the value increases, only shareholder wealth increases. How do we do that? When we are funding, we need to ensure that the weighted average cost of capital is minimized. When weighted average cost of capital is minimized, only shareholder wealth increase. So rather, when weighted average cost of capital reduces, your enterprise value increases. When enterprise value increases, shareholder wealth increases. So this is why minimizing your weighted average cost of capital is important. This is why minimizing your weighted average cost of capital is important. So what is weighted average cost of capital or WACC in the first place? For every 1 rupee of funding that you obtain, what is the average cost? So if the WACC is 10%, that means every rupee that I obtain as funding, my cost would be 10 cents. So that is what weighted average capital is all about. When the importance of WACC is, as I have highlighted here, when your WACC is reducing, your enterprise value increases, so would be the shareholder value. So it is very important that you manage your WACC and reduce it as much as you can. Another thing that you need to understand is how we calculate the WACC is, if it is incorrect, then that can lead to inaccurate decisions. If you calculate your WACC, if your WACC calculation is wrong, then that can lead to incorrect decisions being undertaken. So when we calculate WACC, so I will explain these things in the future lessons. So WACC is the weighted average of cost of equity and cost of debt. Your cost of equity, so there are only two funding sources any organization can have. What is your cost of equity? What is your cost of debt? The summation of that would be your WACC. The problem is, how do we ascertain cost of equity and cost of debt? Based on market variables. Based on market variables. The problem is these market variables are changing continuously. Your interest rates are changing, your foreign exchange rates are changing, shareholder perceptions are changing, your market risk is changing. So when financial variables are changing, that directly impacts your WACC calculation. The issue is when the WACC is inaccurate, that can lead to incorrect business decisions and incorrect capital allocation decisions. So if your WACC is wrong, that means you have mistakenly invested in wrong projects and in wrong decisions. So you need to examine each component of the WACC to see whether it reflects the current market reality. This is very important. The following you need to take into consideration when you calculate the WACC. Always take the after-tax cost of debt, because your interest has a tax saving. When you obtain debt, that creates a tax saving because interest is tax deductible. So always take the after-tax cost of debt. So we are going to discuss these things further in the upcoming lessons also. When you are evaluating the cost of equity, you need to challenge the model assumptions. So cost of equity, usually we use the CAPM model to calculate the cost of equity. We take the risk-free rate. You need to add the market risk premium, which is beta into the market rate over the risk-free rate. So these variables, beta, market risk and risk-free rate, these variables are changing continuously as I speak or as we speak. Every second, every minute, these variables are changing. So you need to evaluate whether your cost of equity reflects the market reality. Whether the market reality is actually captured in your cost of equity calculation, you need to cross check that. And you need to look at the weightage and see whether your capital mix reflects the target mix rather than historical book value. So always you need to take the target mix when you calculate WACC. That is very important. So how we do WACC calculations, we will discuss this further in the upcoming lesson. So this is just a background knowledge for you all in terms of how you need to calculate weighted average cost of capital. So The next part of treasury management is financial risk management integration. So, financial risk management integration, risk management, this is the third important function of a treasury division. So, as I emphasized again and again, when we obtain money and when we invest money, we are relying on financial markets, and the variables in the financial markets are changing, which exposes the organization to risks. Another thing that you need to understand is risk management is important, and integration of the risk management function to the overall risk management framework also important to ensure that you are not duplicating, to ensure that the organization is not duplicating. So, whatever the risk management activities the treasury department is doing, they should do that in coordination with the overall risk management framework of the entity. That is very important, because risk management is all about identifying barriers. So, anything that becomes a barrier to the achievement of your strategic objectives is a risk. So, risk management, financial risk management needs to be done being properly aligned to the overall risk management framework of the organization. If not, that doesn't add value to the organization. So, your treasury department must be doing something else and your risk management department must be doing a totally different thing. So, there needs to be alignment between these two functions in terms of evaluating risks. Then only that benefits the organization in terms of achievement of strategic objectives. So, what are the tools you can use to evaluate and manage risk? So, one thing is you can use value at risk. So, this is a statistical model that we use when we want to identify what is the maximum loss of value that can occur within a specific time period and within a given confidence level. So, that is what value at risk will show. So, usually what we do is we assume that your returns are normally distributed. So, we usually assume that your returns are normally distributed under a bell curve. So, let's say your portfolio value is 100 million. Let's say your portfolio value is 100 million and your standard deviation or the volatility is 10%. So, let's say I have an equity portfolio of 100 million. So, let's say I have an equity portfolio of 100 million. The daily standard deviation of the Colombo stock market, let's say it's 10%. So, using these two variables, what is the maximum that I will lose after 5 trading days? After 5 trading days, what is the maximum loss that can occur with a 95% confidence interval or with a 99% confidence interval? That value in terms of percentage will be provided by when you do the value at risk. So, you can read further about these models. This is a very simple model. Every person can understand what this model is all about. So, what the value at risk model does is, it gives a number to your actual market risk. It gives a number, it quantifies the actual market risk, which helps the organization when it comes to making risk management decisions. So, but there is a caveat. Every model that you do, you need to verify the assumptions. So, this we discussed in the last week's class also. Every financial model that you use, you need to check the assumptions. The assumptions you need to verify to see whether the assumptions are realistic, whether the assumptions reflect the current actual market reality. Then only your your risk analysis will become more and more prudent. The second tool that we have at our disposal when it comes to risk management is hedging. So hedging became a famous hot topic in Sri Lanka when the Ceylon Petroleum Corporation got the hedging mechanics of oil futures. When they got it totally wrong, hedging became a very high level topic in Sri Lanka. So what is hedging? Hedging is all about covering your exposure. So let's say that I am worried about interest rates declining. So let's say I am an organization and I am worried about interest rates rising because that creates a cost to me. So how am I going to hedge that risk? Let's say I am an importer. Let's say I am an importer of medical equipments. I am worried about the currency depreciation. I am worried about the fact that the dollar might move to 350 from 310 to 350 in 2 months. So how I am going to cover that risk? So that is what hedging is all about. Covering your exposure, countering your exposure, that is what we call hedging. So hedging we do to mitigate your risks. Hedging is not to earn profits, guys. So please remember, hedging is all about covering your risks or mitigating your risks. So your hedging strategy is a very key part of the risk management framework of the organization. So whether we are going for forwards, options or swaps. So what are the hedging instruments we are going to use to cover our risk exposure? That you need to decide very prudently, looking at the demands of the organization, looking at the strategic objectives of the organization. So when you decide hedging, how to hedge, what instruments you use in terms of hedging, you need to understand hedging is not only about the risk reduction, but whether your overall strategy objectives are not being impacted. That is also important. So if I am using a hedging tool, not only the risk but also my objectives as an organization also should not be impacted in a bad manner. So hedging is all about risk reduction, and also your strategic objectives should not be harmed by the type of hedging instruments that you are going to use. So the following things you need to look at: whether your risk exposure, so whether your actual risk exposure and the time period of the hedging instrument, whether these two match. Let's say, using the same example, I am worried about the US dollar increasing from 310 to 350 in 2 months. If this is so, I need to buy a forward which is expiring in 2 months. So the hedging protection should match with your risk exposure. The hedging protection should exactly match with the time duration of your risk exposure. And you need to check the value of the derivative that you are going to buy with your actual exposure. So if my actual exposure is 300 million, then the derivative value that I need to buy also should be 300 million. And also you need to look at the cost of the hedging instruments. So these hedging instruments are not free, guys. They come with a cost. They will come with lots of restrictions that impacts your flexibility. So you need to evaluate the total cost of hedging instruments also. Treasury performance metrics and KPI. So treasury performance metrics refers to KPIs that measure the efficiency of liquidity funding and risk management activities of an organization. So because treasury function is important, because the treasury function is important, you need to create a mechanism where the performance of the organization in relation to treasury management is also measured and monitored. We do understand that treasury function is important. Therefore, we need to create a mechanism where you evaluate the performance of the treasury division. So, to that you need to use performance metrics and KPIs. Then only you can evaluate whether your treasury department is on the right track. So, it is very important to measure the performance of your treasury department. An improper treasury function can be a black box where it doesn't provide any benefit to the organization. Having a treasury function that doesn't provide a benefit to the organization, so that is actually not a value adding thing. Treasury function should be a value adding function to the organization. If you don't measure the performance of the treasury department, what happens is you do not know whether your treasury department actually adds value to the organization. That is what we call a black box. We do not know what is inside the black box. So, you cannot allow your treasury function to be a black box. You need to evaluate its performance. Then only you can assess whether it actually contributes to the organization. So, you need to have treasury related KPIs, and you need to have treasury related KPIs to measure the performance of your treasury department related to risk management, related to working capital, and related to the fund management. So, working capital efficiency, you need to look at the cash conversion cycle. So, cash conversion cycle is you take the days sales outstanding, days inventory outstanding minus the date payment outstanding. So, let's say the cash cycle gives you 60 days. What does it mean? It means your cash is trapped for 60 days, which is whether it's good or not, you need to compare it with the industry standards. So, you need to always evaluate the cash cycle in an organization to see whether your cash gets unnecessarily trapped for a long time duration. That is very important. When the cash cycle is increasing, then what that means is cash is unnecessarily trapped within your operation. In case if you want further funding, you need to rely on costly external funding, which will reduce the returns on the capital. When your cash is trapped in working capital, you need to borrow money at a higher cost. So, that will reduce your net profitability for the organization. Each component of the cash cycle, you need to evaluate and see whether there are opportunities of reducing the time duration of the cash cycle. That is very important. So, the following things you need to verify. You need to look at the days sales outstanding. So, this refers to days sales outstanding, which means how many days your sales, the time that is taken, the average time that is taken by your debtors to pay cash to you. The average time taken by the debtors to pay cash to you. So, you need to see whether your day sales outstanding as an organization, whether it is on par with the industry standards and industry benchmarks. So, measure the cash impact of targeted improvements in each CCC component. So, you need to see how each component of your cash cycle impacts the organization. That is very important. And some organizations tend to exploit the creditors. So, when we delay payments to the creditors, we tend to have more cash with us. But when we do that, the creditors become unhappy. So, there is a trade-off between not paying your creditors and holding on to cash. If you hold on to cash, your creditors will not be unhappy. But if you pay them quickly, then you are missing out on cash that you can spend, that you could have spent elsewhere. So you need to evaluate the impact of what is the optimum days payment outstanding that we should have as an organization by looking at the importance. You need to look at the benefit of having cash. You need to look at the benefit of holding to cash versus the supplier damage if you hold on to cash. The benefit of holding on to cash by not paying the supplier versus the supplier damage that can incur due to not paying them. So you need to always do this analysis. Optimizing funding and capital structure. So the optimal capital structure balances the cost of capital measured by WACC with financial flexibility and risk tolerance. So you need to optimize your funding. So we talked about the importance of that. The optimal capital structure balances the cost of capital measured by WACC with financial flexibility and risk tolerance. True. This balance is monitored through metrics like debt to equity ratio, which directly impacts covenant compliance, financial stability and overall cost of funding operations. So you need to create a balance between how much funding you should maintain as an organization. Looking at the risks in the financial markets, how much of funding we need to maintain as an organization. You need to continuously monitor these KPIs. So you need to continuously monitor these KPIs, which is very important. What is your WACC? Whether your WACC is increasing or decreasing. Whether the market risk is increasing or decreasing. So these variables you need to evaluate, then only you can measure treasury performance. So if the WACC is increasing, day by day, but the market risk is decreasing, if your market risk is decreasing and if your WACC is increasing, then there is a problem with your treasury management function. So you need to evaluate these variables. You need to evaluate your WACC, you need to evaluate your capital structure continuously to see whether your treasury department is actually adding value to the organization. So that is why we have mentioned here these variables you need to monitor continuously to see whether the treasury department actually adds value in relation to strategic asset allocation, in relation to making strategic decisions, in relation to making funding and investment decisions, and also in relation to achievement of wider corporate objectives. So the next part we are going to discuss would be finance leadership in corporate strategy. So you need to be a leader. If you are a finance professional, the necessity of being a leader is very important. You need to champion projects by yourself that adds benefit to the organization. So this is what finance leadership is all about. So the traditional finance role is all about cost cutting, variance analysis, assuming a reporting and a controller role. That is the traditional finance role we see in organizations, but the importance of finance leadership is mentioned when we talk about strategic financial management. So when we talk about strategic finance, we indirectly talk about the importance of leadership. So finance leadership in corporate strategy is always about looking at future. Strategic finance is always about looking at future, what will happen, and based on that, how can we prepare what will happen in the future and how can we prepare as an organization. Traditional finance was always about the past, but strategic finance is always about the future. What will happen, and based on that how it might impact the organization. So finance leadership is very important when we talk about strategic finance, because this directly impacts the corporate strategy of the organization. The traditional finance role should be challenged and replaced with the strategic finance role, which focuses on the future and how future decisions need to be made to maximize value. So you should be a leader and try to evaluate and measure how future incidents can impact the organization, and you need to prepare the organization to face those incidents and challenges, giving the financial input to those decisions in such a manner to support the corporate strategy. That is what we expect from all of you by being a financial leader or by undertaking finance leadership. You need to have a value creation mindset when we evaluate business decisions. You need to always question whether every business decision in fact creates value to the organization or not. You should have a questioning mind and you should always question. It can be even a minor decision, whether this decision adds value to the organization in the first place, whether this decision provides a financial benefit to the organization in the first place. So you need to question each and every business decision to see whether each of the business decision in fact creates value. Now we are going to discuss the strategic business leader framework. So there is a framework related to finance leadership. There are 4 leadership styles that every CFO has, and the degree of the leadership style varies from person to person. So there are 4 roles that you need to assume as a CFO. The roles are steward, operator, strategist and catalyst roles. So steward role is all about protecting the asset. So stewardship means you are being a guardian. So the steward role is all about protecting the assets. Operator role is all about ensuring efficiency. Helping the organization to create future value, that is being encouraged by the strategist and catalyst roles. So strategic finance is all about strategic and catalyst roles. So these are the roles we see under strategic finance. Under traditional finance, you see steward and operator roles. You see steward and you see operator roles. But under strategic finance, you see strategic and catalyst roles. Under traditional finance, you have steward and operator roles. Why we need to learn these 4 roles is, if you focus on one role more than the other, then that might create value destruction to the organization. An imbalance, for example, if you are more focused on protecting your assets, what happens is you are giving less time for strategist and catalyst roles that can identify future growth opportunities to the organization. So when you focus too much on the steward role, what happens is you forget to look at the future growth opportunities, you forget to look at the future growth. You miss out on looking at the future and how to drive the organization to the future. Therefore, you need to create a balance in relation to these 4 roles. You need to give considerable attention to all these 4 roles. when we look at our allocation within your finance team also, you need to give significant time allocation among these 4 roles on a similar manner. So, not only to manage steward and operator roles, your finance team should be provided sufficient hours so that they can perform strategic and catalyst roles as well. And if there is a skill shortage, if your finance members do not have the skills to manage this, then you need to somehow bridge the gap in terms of skill shortage. So, if your people do not have the skill to manage the strategist and catalyst roles, then you need to bridge that skill shortage. That is also very important. So, how we usually do is, we identify the 4 roles: strategist, catalyst, steward and operator. So, what we need to do is, what is the current our allocation in terms of hours, what is the percentage which is dedicated now based on the future. So decide means based on strategic expectations. Based on your strategic expectations, how much of hours you desire to invest, but how much you are investing now. How much you are investing now in terms of your expectations, how much you are looking forward to invest. So you need to always do a gap analysis for each of the 4 roles. How much of hours currently we are investing, but based on the strategic expectations, how much hours we need to invest. So you need to compare and do a gap analysis. So cultivating strategic influence with stakeholders. So that is also something which is very important. Strategic influence requires translating complex financial data into a compelling story tailored to different stakeholders. So when you communicate to stakeholders, you need to give a different message to each of the stakeholders. The same message that you give the investors, you cannot give to the general public, because these people do not understand technical jargons. The same message you give your creditors, you cannot give to your public. So, a common message fails to address the specific concerns of the stakeholders. So, you need to develop specific communication strategies related to your financial well-being, related to your strategic objectives. That is very important. Specific targeted communication strategies you need to do for each of your stakeholder groups. Then only these stakeholders will understand what the organization is actually doing, and it minimizes the harm to the organization also. Based on the stakeholders' demand, you need to tailor-make your story or the narrative in such a manner so that the stakeholder will be happy. If you provide a common story to all the stakeholders, then that can create certain issues. So how you communicate with the stakeholders also is very important, and that is one of the roles, one of the skills that you should have as a CFO. This is one of the skills you should have as a CFO. Strategic initiative leadership excellence. So, business skills validation is the rigorous testing of all financial projections and strategic assumptions. So, you need to check all your projections to see whether your projections are in fact is a reflection, whether your projections are realistic, whether your projections are actually feasible. That is very important. Always there are people will always, when you are a CFO, people will always come and tell you, look here, we need to invest here, look here, we need to invest there. this will give you the highest return, no, that will give you the highest return. So you need to be very careful when people come and give you financial projections. You need to always verify whether the financial projections reflect the market reality, because if the projections are wrong and if you take business decisions based on wrong projections, you are allocating money to areas that doesn't generate the highest return on investment. So you need to be very careful when people come up with different projections and numbers. An unchallenged business case with inflated projections can lead to significant capital misallocation and shareholder value erosion. So people, you need to always evaluate when people bring you different proposals, they will inflate the numbers just to show a higher return. You need to be very careful as the CFO when you go through proposals provided by other parties, because usually they inflate projections to show better returns, but the actual reality is very different to what is mentioned or what is highlighted in the projections. So you need to scrutinize the business projections, and assurance should be provided that proposed returns are grounded in verified data and realistic assumptions. You need to always cross-check as the CEO whether the proposals are based on proper data and proper assumptions. So scrutinizing strategic assumptions, this is very important. Strategic initiatives will come with financial projections. For example, people will come to you and say, we need to develop a new product, so this will give you this much of returns. So always you need to verify these projections, because if you don't verify this, if you take a wrong business decision, then you are completely done. Sometimes you might even lose your job as the CFO. So you need to always verify the assumptions. You need to always verify the assumptions that are mentioned in the business cases before you undertake a major investment, before you develop a new product, before you think of expanding your operation overseas. So always you need to cross-check the assumptions and verify the assumptions before undertaking major investment decisions. And also, to check whether you are on the right track, you need to always develop proper KPIs to monitor the progress of the decisions that you undertook, and you need to quantify the financial impact of execution risks and develop appropriate mitigation strategies. So if there are risks that are impacting you while during the course of making investments, during the course of undertaking new projects, then you need to find a method to mitigate the impact of those risks. That is very important, because always people will always highlight the returns. So as when you are the CFO, people will always come and tell you, look here, invest here, invest there, this will give you the highest return, but no one will tell you about the risk. So you need to quantify the impact of the financial risk also to see, in case if you are impacted by the risk, whether you have proper coverage for those risks, whether you have taken proper coverage for those risks. That is also important, because people will always tell you about the returns, they will never tell you about the actual risk that you are exposed to if you undertake certain decisions. Calibrating investment thresholds. A capital hurdle rate serves as the minimum acceptable rate of return, but applying a generic WACC to all your projects is not a proper finance practice. So you need to develop project specific WACC calculations, then only you can evaluate and see whether the projects are in fact providing you with a return after incorporating the project specific risks. So let's say you have project 1. So let's say project 1, project 2. So You cannot use the same WACC. You cannot use the WACC for project 1 and project 2. You cannot use the overall WACC to project 1 and project 2 because risk profile of these projects are different. Because risk profiles of projects are different. So you need to always use project specific discount rates when you evaluate feasibility of those specific projects, because if you use the company-wide WACC to evaluate projects, that is completely wrong. Project specific cost or project specific WACC you need to identify, which incorporates the specific market operational and execution risks in relation to those specific projects. For example, let's say the project 1 is new product development. Let's say the project 2 is new, that is also new product development, but to a overseas market, So what project has more risk? Definitely project 2 will have higher risk. If you are a Sri Lankan operator, the risk of a new product development in Sri Lanka will have a lower risk exposure compared to a scenario where you develop a new product and market it overseas. The risk is high. Because the risk is high in the second project, you need to incorporate a higher return for that project, higher target hurdle rate for that project. So this is how you need to do, this is how you need to undertake or you need to calibrate investment thresholds when you undertake investment appraisal. High risk projects, you need to use a higher rate. So high risk projects such as overseas expansion, high risk projects such as doing a new product overseas or launching a new product overseas should have a higher hurdle rate compared to a scenario where you are doing a minor improvement to one of your current product lines. For example, changing the color of the sunlight packaging from yellow to purple, the hurdle rate should be lower compared to a situation where you market that product somewhere in China or Maldives. Digital transformation championship. So, businesses should always be concerned about digital transformation. You cannot ignore digital transformation also, that is very important. Why you cannot ignore digital transformation is, if your competitors are digitally transforming, but if you are not, then that itself is a big risk. So digital transformation is necessary. You cannot ignore digital transformation. You cannot ignore digital transformation. Because if you do that, your competitors will move forward but you are on the same platform. You need to undertake digital transformation also, but there is a caveat. There is something that you should be mindful of. When you undertake digital investments, you need to see whether that actually generates value. You need to see whether that actually generates value to the organization. That is very important. So different IT vendors come behind you and market their products. They will say you will get this much of benefit, that much of benefit, but you need to be mindful as a CEO and you need to be mindful as a CFO and see whether the digital investments that you undertake, whether these investments in fact generate value to the organization. You need to focus on sustainable value creation rather than cutting down the cost. So whether you create value in the long term, whether value is generated even in the long term for the organization for every rupee that we spend on digital transformation or initiatives. That is what you need to focus as a CFO. So you need to quantify the strategic value. So you need to look at the financial value and also the strategic value. So when you appraise your investments by using net present value, it will only provide you the financial impact. It will only provide you the financial impact. But there is something called strategic impact. There is something called strategic impact. When you undertake digital transformation, it improves your capabilities, it improves your service levels. And what about the customer satisfaction? The customer satisfaction will also be high. So this strategic benefit should also be considered in decision making. The strategic benefit alongside the financial impact also should be considered in decision making. Any assessment of digital initiatives should also look at the financial returns, should also look at the long-term strategic advantages also. So this is very important. The strategic impact also you need to take into consideration when you evaluate digital transformation projects. So the following you need to evaluate. So when you measure the impact of working capital by identifying reduction in the receivable days and inventory holding requirements, evaluating the value of proprietary data assets using comparable market transactions or licensing potential, analyze the financial uplift from enhanced customer lifetime value through improved digital engagement and reduced churn. So whether your customers are happy because you launched a website. So let's say you launched a website. And as a result of that, your customers are staying, the customers who used to stay with you for 5 years, now they are staying with you for 10 years. So there is a financial improvement due to customer retention. So you need to evaluate these variables. Then only you can make a proper assessment of the strategic value of digital transformation projects. Also, you need to look at the data assets. How do you manage the data? Where you store your data? What is the value of your data? So data is something very valuable, guys. So whether the value of data you can generate by launching a website, you can get customer information, customer purchase history. So that data you gather, you can use it to generate business insights. So why do you think when you give a loyalty number, when you buy from the supermarket, why they give you a discount? Because the more and more you use the loyalty number, people can analyze your purchasing pattern, and by doing that they can develop insights in terms of what products they should market more often than not. So people are giving you a discount when you enter the loyalty number. That is actually not for charity, because when they get more and more data related to your purchase history, they can develop better strategic insights based on that. So the value of data that you generate, you need to also take into consideration in decision making. And the improvement to the working capital, that also you need to evaluate in your decision making. So there's something called digital ROI, where you look at the financial return and also the strategic return when you undertake technological investments. So you need to look at not only the financial return but the strategic return also under the concept of digital ROI. And if you want to make a proper assessment, you need to factor in both financial and strategic return evaluation as well. That is very important. So the next what we have is mergers and acquisition strategy and execution leadership, and investor relations and capital market leadership. So these two aspects, yeah. So I will quickly go through these aspects. Mergers and acquisition strategy and execution leadership. So when we talk about mergers and acquisitions, why organizations go ahead with mergers and acquisitions is because there's something called synergy benefit that you realize when you create a merger or when you acquire another entity. It could be a competitor and it might not be a competitor also. Synergy is the actual benefit that you receive. Synergy is the benefit that you receive when you undertake a merger or when you undertake an acquisition. So the very important point is, people will come behind you when you are the CFO. People will come behind you, say, look here, we have enough money, let's acquire the competitor or let's acquire this organization, it will give you this much of benefits. So many people, when you are the CFO, people will come to you and tell you all these stories. But you need to be very mindful and you need to see whether these synergies are properly validated or whether the projected synergies actually provide a benefit to the entity, whether the synergies are actually realized, whether you can actually realize those synergies, and whether the synergies provide a financial benefit also. So when you talk about synergies, two things: whether you can realize these synergies, whether you can actually realize or achieve the synergies, and the second one is whether it provides a financial benefit to the entity, whether it actually provides a financial benefit to the entity. These two things you need to evaluate when you are a CFO. So synergy forecast you need to scrutinize. So when we talk about synergies, there are two types. There are cost synergies and there are revenue synergies. When you do a merger, when you do an acquisition, your cost will come down. That is one benefit you will receive, or your revenue will go up. So these are the only two ways in which you can develop synergies. So you need to see, especially revenue synergies, which are more speculative. You need to see whether these synergies actually realize for the benefit of the organization. You need to check the assumptions related to synergy forecast, and you need to see whether these assumptions are true or not, whether the valuation is true or not, whether the valuation takes into account the relevant risk factors or not. So you need to verify the assumptions of synergy forecast. You need to look at integration costs to see whether the related cost of the synergy in relation to system migration, in related to making severance payments. So when you acquire companies and when you lay off people, you need to make termination payments to employees. So whether those are taken into account. When two entities are merging into one, you need to migrate your systems. So that requires lot of expenses. So whether these things are taken into account, you need to properly verify, and you need to see whether the revenue synergies are actually true, whether you are looking at the same customer base again, customer attrition risk and potential channel conflicts. So whether the same customer base is getting duplicated when we talk about revenue synergies, or whether there is cannibalization, whether people move out of the organization if we merge or if we acquire another entity. So these things you need to see. Whether the customer retention declines if we make a merger or acquisition. So that is what customer attrition risk means, and potential channel conflicts. The expected timeline for synergy realization against historical benchmarks, apply risk adjusted discount rates. So you need to see whether the promised synergies you realized during the course of the timeline that you are investigating. That is very important. For example, let's say you have 2000 clients and you identify 1000 non-overlapping customers. So let's say there's a 15% success rate of getting them and 500,000 average revenue, you get 75 million. But then you realize due to the merger or the acquisition, you will retain only 20% of the consumers that you acquire. Attrition means retention. The customers that you acquire, you realize 20% of them will definitely go out from the system. So the actual synergy value is 60 million, not the promised 200 million. And validating post-merger integration requirements. Beyond the financial projections related to realization of synergy benefits, failures can occur during post-merger integration. So when two entities are combined to become one, definitely there can be issues, there can be obstacles, there can be failures, because due to underestimating operational dependencies and cultural barriers and time requirement. You might not know the language, you might not know the culture where the other entity which is operational in the other entity. So there can be disruptions. So when two entities combine with each other, there can be disruptions, there can be mismatches, so which can create failure. So post-merger integration is very important. There can be operational mismatches or operational barriers. So you need to create realistic project plans and measure milestones in terms of post-merger integration to see whether the paper synergies, whether the synergies that people highlighted on paper, whether that is converted to actual cash flows. So analyzing operational dependencies by mapping each synergy to specific systems. So I have given an example here. So people come to you and say there is a 50 million procurement synergy by consolidating supplier contracts, but you identify that achieving this requires integrating two incompatible ERP systems. For you to do that, there is a hidden cost where you have to integrate two ERP systems. So you had to spend 120 million for system integration and 80 million in terms of contract break fees. So this exceeds the benefit that was proposed to me, so I should not go behind this particular proposal, because the cost of that is more than the benefit. So from this point I will stop my chapter discussion. In the next session we will talk about investor relations, capital market leadership, and also we will talk about financial strategy development and policy formulation as well. So I hope you all will join in the next week class also to discuss another area related to strategic financial management. Thank you.